Welcome to those who are joining us virtually, and we will be, some of them, making an intervention in this particular part of the think tanking. But the reason why we somehow separated, clustered, is simply because the financial inclusion strategies, as conventionally are referred to, they are not all about cryptocurrencies and crypto space and everything else. They are about the kind of issues that this morning the governors related to, and even what they had time to relate to, there are only signals of what is taking place in most of the countries by his colleagues. So the purpose of the think tanking is to pick up signals, to feel the pulse, and then to build on it. So this particular session is, we call it Accelerating Learning and Innovating, as distinct from the next one, which will be Leveraging, Measuring and Navigating. I suppose the Accelerating and Innovating, the one that we are here, is very much referring to the digital controversies or digital crises, if we can call them digital. So we have quite a number of new smart partners here who joined the governors, and very grateful to them. I'm not very sure how much they understand what do we do here, but the governor of Eswatini did mention that this kind of forum that the Smart Partnership built up are extremely useful for them and for everybody else. So welcome, and we hope you'll become smart partners from now on. And in case you choose to do that, you either pin yourself down with the Smart Partners pin that is on your table, or you come to me and I'll tell you why you should do that. But very welcome. There is, right at the beginning, a little, very short video. I don't know if to call it videos nowadays. The lexicon is quite. Joseph, could you? Which is from Data Science Institute in, you have the Bitcoin video, because before we talk about Bitcoin, the idea was that, and we are not likely to talk about Bitcoin, but there is this visualization that people refer to that is required, because all this data and Bitcoin, everything else is not visible. Yeah, Joseph? So David Hand, who will come later on, from Professor David Hand, and we have another colleague from a data science institute in Manchester, so that's not your competitor, but here we are. They have a big data visualization kind of in Imperial College.
Big data presents a large challenge to the visualization community, in that there's now so much more data to visualize, but the window that you have onto that data is essentially the same size. Welcome to the Data Science Institute at Imperial College London. The facility you're standing within is the KPMG Data Observatory. Its goal is to help you visualize big data and to make sense of it in a social fashion. Bitcoin is an online currency. It's maintained by a network of computers around the world. What we have on this plot here is a visualization of the computers on the network, which are the blue dots on here. This is coming through in live real time. The spikes that you see on this plot are the transactions in Bitcoin. The spikes will grow over time, showing you the global distribution of the currency. This is the work of one of our MSc students, Dan McGinn. This is his final project. The goal of this essentially is to give us an idea of the topology of the transactions on this screen. When you see one of these structures like this, this is essentially one account, which is the white line around the edge, making one payment using lots of small bitcoins. Now the opposite of that would be one of these blue stars, like this one here, which is making lots of payments with one Bitcoin. So one thing you can see on this, for example, is the chains of transactions, like these ones just here. And essentially this is following money through the Bitcoin economy. So this is essentially Alice pays Bob, Bob pays Charlie, Charlie pays David, and you can follow the flow of money through the Bitcoin economy in real time. On the screen at the moment, there is about $5 million worth of Bitcoin transactions on the screen. These kind of worm-like spaghetti structures on here, now these actually correspond to essentially an attack on the Bitcoin network. Now this is one individual block in the blockchain. This is 1 megabyte worth of data, so about 10 minutes worth of Bitcoin transactions. If the last two visualizations were a data frequency attack, this essentially is a data complexity attack. So these transactions here are so heavily intertwined that it's very hard to work out or what exactly is happening behind this. And this actually corresponds essentially to a money laundering service. So this is a group of tightly coupled transactions which are repeatedly splitting apart and rejoining Bitcoins, sending them to different addresses in the meantime. The most important things we've seen from these visualizations here has essentially been a window into the types of transactions that we see, particularly the types of attack we've seen on the Bitcoin network, being able to really dig into and explore collaboratively as a group those findings has been a fascinating experience for us.
In the Bank of England, a FinTech hub or this kind of technologies that are emerging are being absorbed, are being watched, or what one can do about it. But you already have your FinTech hub, so probably she will tell you, Cordelia, how they go about it. And later on, a colleague of her from data visualization unit, again a very, very recent unit, she was with a data analytics data unit in the bank itself. They will share their experience, which is very recent. This is just beginning to shape up within the bank. So that is what is happening at the beginning. We have an input and a contribution from our smart partner Robin Grosset from the Mindbridge from Canada, who sent for you a specific example of real-time application of artificial intelligence on audit, which we can see over the lunch in the garden room. But and also we have quite a number of other reading tips. I don't know who has time to have all these reading tips, which we made them available physically, but also on email. For instance, the AI and data analytics from the chief scientist Tim Pearson from Government Accountability Office, who is part of our group for a number of years. So I suppose, Cordelia, and thank you for coming.
FinTech Hub at the Bank of England back in March. And actually listening to the last discussion, it was interesting because I think we do share a lot of the same challenges. In terms of financial inclusion, I mean, our country, most people do have access to a bank account and financial services. But we have a very established banking system in the United Kingdom, and a lot of people are still reliant on cash. 2.5 million people, 5% of our population, are still reliant on cash in this country. And the use of mobile money and smartphones for transactions is actually very low. People are using their debit cards and their credit cards still. And so, just like all of you do, we need to think about the future of financial services. We need to think about who, what, how are we going to be regulating financial services? How are our citizens going to be accessing financial services? How are our businesses going to get funded in the future? And what do we need to do as a central bank to prepare for that, to prepare our staff for that, but also to help prepare the whole financial system for that? And that's why we set up our FinTech Hub back in March. It's a small team that works across the bank. and I can talk through some of the topics that we're currently considering, and then happy to take some questions.
Cordelia sent PowerPoints, but we said if it's PowerPoints, then she wouldn't look at you. So, but it's available. It's available in printed out form or however else. Please.
So some of the things that we're thinking about is how is the structure of our banking system, our insurance system, our financial services system going to change over the next 5, 10, 15 years? You know, so much has changed with the emergence of smartphones in the last 10 years, and what's it going to look like in the next 10 years? And some of the things we're thinking about there is how financial services might be unbundled. So currently, you know, our banks are quite universal. They do lending, current accounts, saving accounts, but how might that be unbundled in the future? Be that from new financial technology companies, or actually some of the big technology companies, like what we've seen with China. Some of the e-commerce firms and social media firms have now kind of taken over the financial services sector in China. Might something happen here in the UK? We are starting from a different... Max Ganado from Malta. Hi. And welcome. We're starting from a different position, but that could happen here. And what does that mean for the UK financial services system? We're not here to protect the banks, but we want to understand how we might transition to a different way of accessing financial services, for example, through platforms in the future. We need to think about whether we've got the right staff to ask the right questions if technology companies, e-commerce companies enter into financial services. And if they enter in a way in which they become the customer interface, you know, do they become systemic, and what does that mean for financial stability? So there's some of the questions that we're thinking about when it comes to big tech and the disintermediation of the current financial services sector and the current banking system. We are also linked to that thinking about the use of cloud technology. More and more of our financial services sector is getting moved onto the cloud, and just like our colleague was saying earlier, we can't just say, no, that's not okay. We don't want to stop and prohibit innovation. We need to think about how that can be done and how firms can move to using that new infrastructure, but in a safe and resilient way. So that's a kind of another work stream that we have. We, of course, are thinking about cryptocurrencies. I think we all face the same challenge in understanding kind of what they are, what the differences are between the thousands of crypto assets that currently occur, and what does that mean in terms of our response? You know, we could take a response to isolate them, we could integrate them, or we could regulate them. And some countries have taken the approach to isolating them, but we think that's not an approach which is really that realistic in the long term, because they're going to come back in different ways, different different technologies are going to evolve as well. But we do need to think about where they may pose harms to consumers. That's the remit of our sister organisation, the Financial Conduct Authority, investors, and then also financial stability, which is, of course, our remit at the central bank, and monetary stability. Right now, we don't see that they pose a risk to financial stability, and in our financial stability report earlier this year, we set out why we thought that was the case. But essentially, cryptocurrencies currently aren't a good form of money, and they're not massively interconnected with the mainstream financial system or systemically important markets. But of course, that was something that will change as they scale and the technology becomes more mature, and that's something that we'll monitor. And we have a joint task force with the Bank of England, HM Treasury, our Finance Ministry, and the Financial Conduct Authority to look into cryptocurrencies, crypto assets in more detail, and we'll be reporting back as a task force in September or October this year.
So how is the unit, the hub, participating into that?
So the hub is a key player in that. So the hub is really a hub at the centre of the bank. It's a small team. When we're up to full capacity, there'll be 6 of us. But to cover the breadth of the bank's remit on monetary stability, financial stability, and prudential regulation. And so what we do is we use our spokes in the rest of the business. So, for example, in terms of the government's crypto asset task force, we work closely with our digital currencies team that's actually based in our banknote directorate. And together with them, we're participating heavily into that task force. We work with our prudential regulators in our Prudential Regulation Authority that's part of the Bank of England to think about if banks are holding or investing in cryptocurrency, what's the right capital treatment, what's the right prudential treatment, and work with our experts there. So the role of the hub is really to have that holistic view of fintech work across the organisation and to influence it to think about what matters most for the future of the financial system, but then work with our experts within the rest of the organisation on these topics.
How much is the governor hands-on like our governors?
Yeah, so
recently he gave a speech.
Yes,
in
so
Mansion House.
exactly. Yeah, so our governor is very interested in financial technology and the future of financial services. As you said, at his Mansion House speech, which is our big kind of annual flagship speech, just this month, he talked about the future of financial services. He talked about it needing to be fit and right for the end user, and some of the things that we're doing to support that and to support frictionless financial services in the future. One big thing that we did to support that is actually to give access to our balance sheet, to our real-time gross settlement system, to payment services providers. So now they can have a bank account with us rather than having to go through the banking system. And they can be direct members of our faster payment system. And the other thing that we're doing is the governor has just appointed a new advisor to work with him on the future of financial services. That was also mentioned in this speech just a couple of weeks ago. And he will be producing a report probably early next year on the future of financial services and what we can do at the Bank of England to support that in a kind of safe and resilient way, and how we need to change and evolve as well as an organisation, how we need to make use of artificial intelligence, big data analysis for our own work as well. You know, whether we're thinking about enhancing the way we look at monetary policy or how we look at unstructured data as supervisors, how should we be using these new technologies as well as understanding how they're being used in the financial system and the safety and resilience consequences of that.
And the proof of concept phase, because a number of years ago, 3 years ago?
Yeah, I can tell you. So previously to the FinTech Hub, we had our FinTech Accelerator. And the FinTech Accelerator was really about accelerating our understanding at the Bank of England on new technologies, on getting our hands dirty with distributed ledger technology, with machine learning, and thinking about how we could use that within the organisation. And we did 4 cohorts of 14 proof of concepts. One actually with Mindbridge, who you're going to be demoing today. Not our proof of concept, but just demoing their company, to consider how we can use these technologies internally to enhance our supervisory capability to ensure that we're adopting technologies for the future as well. We're still doing proof of concepts where there's a business need. We're currently doing one on machine learning and supervision, and currently doing one on how our new real-time gross settlement system can interoperate with distributed ledger technology platforms. But we're not doing it on a cohort basis now. It's really being driven by business need. When there's a business need, we'll go out and do one. So it's focused on when we really need to use new technologies.
And from the point of view of legislation, because Max is waiting to probably come in from Malta, where are we in UK in relation to regulatory legislation framework for crypto and virtual currencies?
Yeah, so in terms of the regulation of crypto, that's something that this task force is going to be looking at. It's going to be looking at where are the gaps in regulation and other consumer harms that aren't being mitigated that need to be, and that's something that the task force will look at. We're also working closely in the international committees at the Financial Stability Board, Basel committees, and with our European counterparts who are also looking at kind of where regulations may need to be enhanced due to financial technology. For example, the European banking authorities consulting on some enhanced outsourcing guidelines when it comes to the use of cloud technology.
I don't know if Max. Max, so thank you very much for joining us, and I will just try to say just a few things about how you and me we got together. even virtually, and how did I persuade you to join us today. And there was about a month ago, Professor Mutabile and colleagues in Uganda, they had to explain, they were put on the spot more or less about a cryptocurrency company which came to attract the attention to Uganda, and including the government and so on. And one of the things that immediately struck us was, is there any legislation in Uganda, or is there anywhere else a legislation that is emerging as we speak? And one of our colleagues from Malta said, we are just kind of, the parliament just approved a legislation, and maybe Max Ganado, a well-known family in Malta, and his Ganado advocates, we were put in touch with him, and he was very grateful to share straight away the ins and outs of how that legislation came about in the last few months. So thank you very much, Max.
Thank you. Happy to help. The next law was the Innovative Technology Arrangements and Services Act. Now that picked some parts of the developments in DLT and smart contracts, which could be subject to voluntary regulation. Now that means that we've defined DLT and smart contracts, and then we've said that the authority can certify them if they reach certain standards. And the standards have to be confirmed by a registered systems auditor who would review the technology structures and would have to be monitored after certification by a person we call a technical administrator. So a promoter of a DLT or smart contract arrangement will basically unilaterally undertake to set the technology he is designing or promoting, particularly to the public, and that is where we start protecting consumers. He unilaterally agrees to a standard which is set out in the law. And what is interesting in the law is that it says, that basically the systems auditor must confirm that what is being stated in the description of the technology actually works and operates to the correct standards. The technical administrator, on the other hand, is the one who's looking after it is launched. And the technical administrator is there to ensure it continues to operate as envisaged, and has to have intervention powers, which is, clashing with the approach of purists in this area. He must be able to intervene if there is a loss being caused to anybody, even if it is a risk of loss, and he must intervene if there's a breach of mandatory law in the way the technology is operating. So, for instance, if there's a breach of the AML law or a breach of the GDPR law, which is privacy protection, or if there is a breach of consumer rights, then the technical administrator must have the power to intervene and demand correction of the software in order to stop the negative things happening. The third law, which is the harsher law, is the mandatory law called the Virtual Financial Assets Act. There is a fourth law which is envisaged, and that will come out in a few months' time, which deals with some private law issues, because there's a lot of legal uncertainty in the area, which is not enabling people to manage risk. And our assessment has shown that if you really want to support innovation, you really need to reduce the risk of people designing, promoting, using this technology. You can't have a situation, for instance, where a user, a simple consumer, suddenly becomes jointly and severally liable with the designer and the promoter of the technology just because he's a user of the technology at a time when a loss emerges, which is what happened in some cases where there were some hacks. So in relation to legal certainty, a law is currently being worked on, and that should come out around October or late September. When we talk about the systems auditors and the technical administrators, these people have to be approved by the regulator, they have to be registered, and for them to be approved, they must be assessed to be fit and proper, competent, having integrity, and the shareholders in those organizations having more than 25% of the equity in those companies also have to be approved as fit and proper, as are the directors of those companies. So in terms of standards, we are ensuring that only people who pass a certain amount of testing, which we are used to in the financial world, are involved in these companies. We've also introduced a rule that there has to be an English language description on critical user issues, so that when a person decides to use this technology, he is able to understand it, at least in the English language. Obviously, it can be translated to a manner that he can understand the risks he is undertaking when using that kind of technology. When we move to the virtual assets, which are the hotter area or the riskier area, what we have done is we've introduced what is called a financial instruments test. A financial assets test. Now there, we divided the world of these tokens into broadly 4 parts. If they are investment instruments or e-money, then that is subject to the existing law, because it's there already. It is harmonized in the European Union under MiFID and the payment directives and the e-money directives. And therefore there, what we're saying is that if the classification, according to the test, comes out as pointing to the cryptocurrency being one of those, then there is existing law which is fully applicable. So if you wanted to offer any of these kind of instruments, you'd need to follow the prospectus directive if they happen to be securities, for instance. You then move to the other extreme, which is if they are what we call utilities, which are totally embedded within a context and can only be used on a particular blockchain, do not have any investment value, and they tend to be enabling a person to use them on the blockchain, for instance, to play a game or to record a document or something very, very limited. In the middle, there's a big gray area. And what the financial assets test seeks to do is to determine that if they are neither a security nor a utility, and therefore they have potential investment volatility and risk dimensions for a person who uses or owns them or touches them actually, then there should be a level of regulation for those as well. And therefore we catch those kind of instruments which don't quite qualify in terms of the existing law, and we've created a law called the Virtual Financial Assets Act, which catches that middle ground. And this law is based on the existing financial regulations. It looks very much like the Investment Services Act or the e-money legislation, except that it is designed to be more tolerant and possibly principle-based rather than rule-based. However, having said that, it is a criminal law in its nature. It has very, very harsh penalties for abuse. It goes into potential insider dealing and market manipulation, and therefore these are very serious crimes if they are adopted or used in relation to cryptocurrencies as well. And like that, we ensure that we protect the consumer, we protect the financial system, and we obviously protect the reputation of the country. So having this 3-tier classification ensures that we have applied high-level regulation to what already exists, middle-level regulation to the new industries, and no regulation where it is unnecessary. When you shift to the technology underlying some of this activity, there is a voluntary regime which encourages people to raise the standards of what they are doing to something which is more respectable, with more integrity, with more protection of private user rights. And on the whole, we feel that we've sort of balanced the situation in the law for the current period and the point of development where this technology happens to be at the moment, with full flexibility to adjust as we go along and we see emerging, situations developing in front of us.
Okay, well, I mean, that is... well, Governor, please.
Thank you very much. This was very enlightening, and
Yes, I can hear you.
thank you. One would wish to know if you wanted to have access to the legislation itself, would we find it in your website?
Yes, it will soon be published once it passed through Parliament, which should be today. It will be confirmed by the President, and once it is signed by the President, it then gets published and is electronically available into the website of the Justice Department in Malta, the Ministry of Justice. If you just put laws of Malta and you put in financial assets, you'll then find this legislation. They are the three most recent laws enacted by the Parliament.
Everybody had your notes, yeah?
Yep.
Okay.
This was very powerful. I don't know if colleagues you want, and are there any questions, comments? Lambo, any comments?
Just get a feel of the detail. Could you give us a kind of range of penalties for breach of any regulation, like fraud or breaking into bank? Give us a feeling of
Yes.
the current legislation.
When we talk about the mandatory regulations, we are talking about an issuer of an ICO, and then we're talking of exchanges, we're talking of providers of wallets where cryptocurrencies are held, and we're talking of intermediaries who carry out any activity in relation to advice, to custody, to brokers, and to arrangers of transactions, very similar to the law on financial services in relation to investments. So there's a group of people that is governed by this law, and the maximum penalties that can apply in case of breach of these laws are as high as 10 million euros. So there are very, very high penalties. It could also be twice a percentage of the profits of a company, which is also quite a steep level. Obviously, the court has discretion to apply the penalty according to the breach. Now, one of the big difficulties we have here is that you might apply a penalty, but it doesn't mean that a person actually receives compensation for a loss. So the private law is now the focus of design, and what we are aiming at is something like a new legal entity which will be able to be certified, and one of the requirements of the certification would be the dealing with a recourse fund. So if you have a DLT technology and there is somebody using it and they suffer loss, they must know who to sue or to who claim from. And our idea is to create a foundation which has cells, and one of the cells must have adequate insurance for loss. So a user who suffers loss can actually make a claim against the insurance policy embedded within the structure, and hopefully in the very near future that will start to be covered by smart contracts. So if it's a technological breach which can be confirmed externally, then the smart contract will make sure the insurance policy will actually compensate the user for the loss. It's an area which is developing so fast that the solutions of a regulatory type and the solutions of a compensatory type can be designed in advance. There are already a company in Malta which is doing this in relation to flight delays. If your flight is delayed, and it is shown from the official records of which are kept by the aviation authorities that a flight has been delayed, a smart contract will simply pay you compensation per hour. And you will receive it without even needing to make a claim, because the smart contract picks up the information and knows you have suffered a loss. So, you know, things are developing in a way that is going to help the development of private law to reach the standards which are going to reasonably balance the risk that is being suffered at the moment.
Oliver?
Hi, Max. Really good talk, thanks. Max, you know, Malta's being referred to as now a crypto island. So I just got a question there. Does that mean the banking authorities, due to the new regulation or legislation, are being more open, or you say it's very hard, say, for example, for an exchange to get a bank account in the UK? My second question leads on for that. If it is more friendly in Malta to get a bank account for a crypto exchange, have you been looking at capital levels for these banks?
The answer is very easy. It is impossible to open a bank account here. And what we're telling clients is they need to use their banking relationships wherever they come from to continue the relationship while the company might be operating or being regulated in Malta. I mean, it is one of the biggest problems facing us all, that banks have not engaged with this industry at all. Now, my view is that this is close to a tragedy, because the banks are actually the best center of high standard diligence and regulatory compliance, particularly in the AML area, because they've built up massive compliance teams in those areas. And while the world is sort of shifting into a new technology, the best players in terms of quality control and due diligence are actually not touching it, which means that the risk is increasing for us all, because the people who are carrying out the diligence on these operations are actually the middle tier level, professionals, other intermediaries, who, although obviously committed to respect the law, don't have the same resources. So, my answer to you is banks are not engaging at all. There is a lot of discussion in terms of how to get banks comfortable. There is an argument that if you now have a regulator who has carried out a due diligence on the applicant, and the applicant then passes certain tests, then banks should start becoming a bit more comfortable. Clearly, there should not be any impact on regulatory capital, because they should not impinge regulatory capital through these kind of activities. And so there is an idea of the creation of limitations on what banks can do in relation to these businesses. It's still in development, because the banks are not engaged in the discussion. And it's very, very sad that they're not, because obviously, as the world develops, these things are going to be with us and they're just growing. So someone has to sit down and say what is the best step to take at this point in time, with a future plan in mind, obviously protecting the users of banks and their services, because that's what the last 7 or 8 years has focused on. But generally ensuring that, as this industry develops, it is being encouraged to develop to the right standards, and not sort of moving into a space which is, not touched by the best operators in the industry.
I think we have an issue with this. Can you?
Yeah, thank you very much for the discussion and for showing us what Malta is doing. And we also just really facing similar challenges. I think, I can talk about Zimbabwe. we now have a couple of exchanges, I think about 3 of them, that are operating in the country. So in terms of practical regulation, it's been a bit of a challenge when you think about it, because when we visited these exchanges, it's just a desk and a computer and a few people around the computer. And they don't have a particular space because the other people are doing something else in the same hub, in the same room. I mean, when you regulate a bank, you know that there's a building, there's an office, there's a headquarters, so you know who you are dealing with. But in these ones, it's a guy sitting on a desk with a computer and doing all sorts of stuff. So in terms of disclosure, who actually make, for your disclosure requirements that you have put in place, who are you actually asking it on? Is it on the users? Is it on the operators of the exchange? Is it on the miners? Who's actually doing the disclosures?
Okay, this is a very interesting question. In the Technology Arrangements Act, you will find when you eventually see it, a schedule which tries to address this issue. When you have a company which has cascaded its ownership and governance structure into tokens, who do you look at, and when and how? And what we are proposing is that, if token holders have votes and have controlling powers and have ability to change or influence the technology, then you would look through the shareholding structure and move to that level of review. And you would look at a token holder who has, say, 25% control rights, or an administrator who has governance rights and can actually influence what is happening. However, in relation to an exchange, this is not what we have. We have an operator, a centralized operator. There is one exchange in Malta at the moment, which I'm aware of, which has about 60 employees, and they are operating in a fairly transparent manner. I don't know whether I'm not a regulator myself, I'm a private lawyer, and I know that there has been engagement with the regulator because they want to come under the mandatory regulatory law as soon as possible. And what the mandatory regulatory law says is that an exchange is a regulated activity, and therefore the centralized entity which is managing or operating the exchange has to submit to an application and a full review by the MFSA, which is the regulatory authority in Malta, similar to the Financial Conduct Authority in the UK. Now, to do that, you have to submit all the information about the directors of the company, all the information about the larger shareholders in the company. You have to give a business plan, and you have to have a presence in Malta. So the very, very thin type of operation you have just described will not be possible, because there will have to be an infrastructure of compliance, of reporting, and this sort of stuff, which will have to respond very similarly to what we find in a regulated market, which is typically a stock exchange. So if you had to do that in Malta, I think you would have a more difficult time in terms of compliance. Now, at the moment, we don't have the law, and that's why we had to act. Because if people are just coming here and setting up a room and setting up a computer and running an exchange, then obviously we have a problem, because things are happening without anybody knowing about it or getting involved. This law, when it comes into effect, will require that within a fixed period of time, and I believe it's around 9 months, all these operations which fall within the definitions of a virtual financial asset activity, which involves about 10 types of activities, need to apply and then obtain an authorization. So the regulatory reaction to what you are seeing should be a law which will, set a timeline within which people will come into line. And what that has done, and this is what is quite interesting about this project, is that because the law has been being debated for the last 3 months fairly publicly, people are now naturally designing their projects and their businesses and their structures very much in line with what the law is going to demand. So like that, they know that in a few weeks' time they will have to notify the authority of their existence and their operations in Malta, and within a shorter time, after that, a few months after that, they will actually have to apply. So, they're already unilaterally adjusting to the benchmark that is being set in the legislation. And I think that is the way to go, because at least you get people, going to a higher standard rather than doing it as they see most convenient to themselves.
Max, one of the things that struck me was that the distributed ledger technology, blockchain technology and so on, required, first of all, and in fact we discussed a little bit about it, required a legal definition, a legal identity, because the DLT is a set of relationship, as you were mentioning in one of your description, and people don't think about that. I mean, does a distributed ledger technology or a blockchain technology has a legal identity?
Well, it doesn't. Today it is software, only software. Now, what we are going to do is we're going to encourage people to place it within a legal structure, which is going to give it a legal identity, which means you then have a clear point of recourse, you have a clear point of contracting power, the ability to engage the technical administrator, as I explained, and you then start being able to build a liability regime around it, because you've got a point of recourse and the point of compliance with law, and the point with transparency requirements or whatever. So this is a critical issue, and we've been discussing this issue for about 9 months now. It seems that the reaction of people in the industry is very positive, that by creating a legal entity around this technology, we are going to create much more legal certainty, which will be beneficial to everybody. One aspect which is quite interesting that is being developed here is that if it is a public blockchain, then it needs to be placed into a ring-fenced segregated cell, which will ensure that it is bankruptcy remote. And the reason for that is because if the public is going to use it for their assets to be placed on the blockchain, you can't use that technology as a patrimony to cover liabilities that might emerge, because otherwise everybody else is going to lose the underlying platform on which their assets are based. So in order to reduce the risk of users, you need to ring fence that software and that platform, which is a public register, similar to a public registry, but is not state-owned, and therefore doesn't have that kind of protection, into something we can compare to public domain, or in the English law they call, the commons. It's a bit like the internet. It's an open, an ownerless type of asset which people are using, and you certainly have to protect it a lot from this legal uncertainty in terms of its status. If it's privately owned, then obviously, there's a completely different discussion. But when we're talking of public blockchains, which are going to affect millions of people, you can't afford not to have a clear identification of the ownership and risk structure around it, because that can create massive risk in its wake.
I suppose we should thank to Max very much.
Thank you so much, Max. Thanks for your time, and thanks for your presentation. We must assure you that we do have your PowerPoint presentations. It's very enlightening. We realize that Malta is way steps ahead of many of our countries. The challenges that we have, you have attempted to deal with. The final question that one would have, looking at your PowerPoint, there's an email address at the end. Could we engage you after this, if we just for thoughts and just to bounce ideas on you? Otherwise, I speak on behalf of the smart partners that are here, really in appreciation of your presentation and the time you've taken with us.
Yes, it will be my pleasure. Send me emails, and to the extent I can help, I'll be happy to do so.
Thank you.
Just for about a few minutes, into visualization, because she was talking about blockchain and all these things. So if we come back to the idea of within a bank, a central bank, how does something like this is kind of connected with what it is that Max is talking about, the lawyers. So we have Cordelia, for a few from the Bank of England, sorry, not Cordelia, Lyndsey, Cordelia, yeah, who was very kind to come, and again, they are a very recent unit. She was before with the data analytics unit in Bank of England, again, very new. So these are new type of functions within central banks. So could you tell us a little bit about this?
That we do, why we make certain decisions about the interest rate, and the reason there's been a push for this is because we're trying to build trust in us as an institution. We can look quite impenetrable. The kind of publications that we put out, many people on the street just wouldn't understand what our view is of the economy. And we also produce thousands of charts. I think I counted, and we put out in the public domain 250 charts just in 1 month in 4 publications. And so now I work in communications, trying to improve our communication of data and analysis through our charts, so they're much more accessible and easier to understand. So I had some slides to show you. Yeah, if I could I have a copy? Thanks. There might be. Here, I'm trying to work out. Oh, you've got the long version, so I might skip. I might skip through some of these so that it doesn't take the whole time up. Oh yes, yes. So okay, fine. So I was going to kind of. Oh yes, that would be helpful. I will skip through a few because this is quite a long presentation for this slot. So I'll take you through why we've become more interested in data visualization as a discipline at the bank, and then some examples of how we've used it, just so you can see where we're going. So why do we care about visualization more? Mainly because we just have an influx of data. We have so much data to look through. I think there's about 90% of the world's data has been created in the last 2 years, and we have our fair share of that data. And visualizing it helps us understand patterns in it and explain those patterns to people much more quickly. So I've got a little test. If I ask you how many A's are in the words data visualization, can you tell me? 4. Okay, so it took a few seconds to process that, and also one person didn't said 3. But if I use something visual to highlight that, it makes it much easier to process that there's 4 A's in those 2 words. So kind of visualizing something makes it quicker to process information. You get an understanding about where those A's are positioned in the word, that the first 2 A's are closer together than the second 2 A's. You may be more engaged. You suddenly think, why have they gone orange? And it's all these kind of, this is a very simple example, but it's these kind of reasons why we're pursuing it as a discipline in the bank. So as I say, we have loads of data. We have financial institutions data in their regulatory and statistical returns. So this is about 4 million data points. We have mortgage data, which is about so we have data on every mortgage in the UK. So this is about 500 million data points. We have payments data because we operate the settlement of payments between commercial banks. This is millions of lines of data each day. And we have trade repository data, which is all the derivatives transactions that happen in the EU, which is, again, is millions of transactions per day. So we have millions and millions of data points that we have to try and get some understanding out of, understand patterns, relationships, and also we have to try and explain our results to people. So we may suffer from information overload from all this information. I'll skip these. So as I've said, visualization makes us understand our data more quickly. If you look at this road sign, you can process what it's trying to say much more quickly than reading the text in the right-hand side. It helps us, sorry, this is, this is very old. So another example is that it makes our data more usable and understandable. One example was the Anscombe Quartet. This is Francis Anscombe was a statistician that wanted to prove that to statisticians that calculations, this kind of fallacy that calculations are exact and graphing is rough. He constructed four data sets with completely identical descriptive statistics, so variance, linear regression, averages, but then he showed when you looked at this data, they had just very different patterns. And so if your data had the relationship in the first chart, you may make very different decisions if that was the relationship in your data compared to the last chart. So this is just showing you how when you see the data, you just get a very different understanding of what it's telling you. And for the audience, it makes our kind of data analysis much more engaging. This is kind of a fun fact. We retain 80% of what we see, 20% of what we read, and 10% of what we hear. Although I think my husband may, when he's listening to me, it's less than 10%. But we are programmed. Our minds are programmed to understand and process visual information much more quickly and to remember it. And that's just a little infographic to show that. So at the bank, I like to categorize how we use data visualization in two ways. So we use it for exploration of data, so visual analysis of data, and explanation of data, so communication of our analysis. And I'll just show you some examples of how we've been using it. So we have been using Twitter data to look at who's interested in our communications around inflation reports. This is a big complex data set of 30,000 tweets, and we use network analysis, which is visual analysis, to understand the connections, who's retweeting our communications. And this is kind of a network diagram of tweets in August 2017 inflation report, where we downgraded our growth forecast, but we made no change to the interest rate, versus November 2017 when we put interest rates up. And you can see that we get very different patterns. Yeah, we get very different patterns depending on what we're communicating. So, and different people are interested in different topics. So in August, we see politicians, public figures more interested in our communications because they're making political commentary about Brexit affecting the bank's growth forecast. And in November, we get much more media interest from journalists and news organizations because it's around interest rate rises and how that kind of affects the everyday person. Another example is using trade repository data to look at the structure of a derivatives market. So this is some work that was done on the Swiss franc forwards market after the depegging of the Swiss franc. They wanted to see how what that derivatives market looked like. They cleaned millions of lines of data and could observe about half the market. And as they say, this is the first time anyone could see the market and how connected it was. And this is the diagram of that market. So it was interesting to the people working on this how this market followed. It kind of had a too big to fail theme because it had this kind of inner red core of dealer banks where they were doing most of the business in the market. And so if something happened to one of them, it would really affect the stability of this market. And then the other kind of outer core peripheral banks that were less important to the stability of this market. But they would not have understood these connections, and they would not have seen this had they not visualized it in this way. I don't know what the next example is. Let's see. Oh, it's not. Sorry. Yes. So another example. So I mean, we're starting to use data visualization not just for looking at large, complicated data sets. It can still give us a lot of insight on smaller data sets. And this is an example that I did for our BAME working group. So this is a working group looking at ethnic minority staff and diversity and inclusion at the bank. And they did a survey of the issues, or there's an internal staff survey asking people about what it was like to work at the bank, to see if different issues affected ethnic minority staff. And here, I received a very standard, horrible-looking Excel chart, which it was very hard to see any patterns in the differences between ethnic minority and non-ethnic minority staff. And here, I just reconstructed it in a slightly different chart type, and you can see very clearly that you're getting bigger differences. Ethnic minority staff, which are the orange blobs, are giving lower favourable responses for questions about diversity at the bank. The working group were just very kind of, they couldn't believe that it was so easy to see these patterns when they'd been kind of grappling with the data in Excel for a long time, and they just hadn't seen these kind of results before. Another example of kind of just working on internal business data. The bank wants to encourage stronger collaboration, and so we looked at some data about opportunities across different directorates of the bank and who was applying for them, to see which divisions were taking up opportunities to collaborate in other areas of the bank. And here you can see the darker orange, the prudential regulation divisions are trying to do much more collaboration than other areas of the bank. Again, it would be just much harder to see if you were looking at this in a spreadsheet or a table of numbers. It just wouldn't jump out at you like this. And I can only really say that I think visual analytics is just going to increase exponentially at the Bank of England. We're rolling out a visual analytics tool called Tableau, which means that people can kind of drag and drop data to visually explore it, and without any coding skills. They don't need coding skills in R, Python, so it's kind of visual analytics for the masses, and this is being rolled out this summer, so I can only see like the thousands of analysts that we have working at the bank starting to use this much more, and hopefully transitioning away from Excel and kind of the not very good graphing capabilities in Excel. So I can only see it growing as a discipline. And then the second area we're using data visualization more, as I mentioned, is in communication, which is where I work. And this is my kind of mantra that I tell people that come to comms with how they want to communicate something. So we've just had our financial stability report with some very technical looking, detailed charts that kind of the public or journalists are just going to have to work very hard to understand what we're trying to say. And I just tell them, we just must simplify everything. We must tell a good story based on one key message, not shove everything we can into the chart. And we should design it so it looks aesthetically appealing, so people want to look at it and engage with it. And I'm always so surprised at what a blind spot this is for analysts and people with kind of technical mindset. They just really struggle to simplify something. They want to give a lot of detail. They want to cover all the bases. But as an analyst, you've done all the analytical work, and you need to make it much easier for your audience to understand exactly the results of your work or the key message of your work. And if people want more information, they will seek it out afterwards. I guarantee you most of the UK public don't want more information. They want less. They just want to know in a few simple bullet points exactly what we're talking about. So So in order to kind of learn from this process of making our communication simpler and clearer, we took a pilot project, which is the inflation report. And this is normally 50 pages long. It has about 75 charts in it. As you can see, this is an example page. It's dense. It's dense in text. It's dense in tables, charts. I think our governor, Mark Carney, even said he doesn't really understand exactly what we're saying in the inflation report. That's not a great avocation for it. So we took it as a kind of guinea pig, and we said we're going to make a visual summary of this. We're going to concentrate on 3 or 4 key messages with 3 or 4 key charts as evidence to back up those messages, and so that people understand that we do some analytics to understand what we're saying, and this is just an example of this process of going through simplifying, telling a story, and chart design on one of our inflation report charts to make it more accessible to the public for our visual summary. So this is what it looked like afterwards. So it looks quite different. Instead of having this kind of quite technical chart, sterling has depreciated further since August. We're just saying exactly what we want. The key message is it's the value of the pound has fallen since the EU referendum. We've annotated it directly on the chart. I never see that. I don't know why people don't say exactly what's happening on the chart. Sometimes they put it in text about 3 pages away from the chart. This seems bizarre to me. And so we annotate directly on the chart. We've, I'm just going to see if this highlights. Oh yeah, sorry, it's going through all of the. So descriptive title, not an explanation of the data. We've changed how we've plotted it to euros and US dollars per pound, so that that's something that the everyday person understands, because they change their pounds for euros or dollars. They don't understand baselining and index. That just doesn't compute. Pardon?
Chart where we will integrate crypto.
Oh, I'll show you a chart of that
oh,
later.
that.
Yeah. And what else? Oh yeah, labeling directly on the chart, not in a legend somewhere else where you have to keep looking back and forward. And in the same color as the series. This is revolutionary. We used to label everything in black and you couldn't see what was what. Putting in reference lines for what you're talking about, the EU referendum, getting rid of all those tick marks. I mean, who cares that it's every 5, it's going up by every 5. Graying out less important information to just focus people on the trend. Oh yeah, sorry. This is going through every single one. I'm trying to speed it up. Yeah, I'll show you. I'll just take you through another couple of examples. So this is another example of this story in the chart, which we post on social media, and we just, I mean, kind of 81 retweets and 70 likes is good going for a central bank on social media. I know, like, it's probably not if you're just a normal person, but this is pretty good for us. And I just highlight, it got more retweets and likes than Mr. Carney himself and his quote. So people are engaging with this kind of evidence-based storytelling as long as it's simple and easy to understand and they can get the message from it. And less so with just a big chunk of text or a badly designed chart. We don't get those kind of numbers with the charts that we normally see coming out of the Bank of England. And then, yeah, again, we're starting to build this into other things. So we have knowledge bank guides on the economy, and we're trying to build in these simple, accessible charts in these. This is one about house prices. It's interactive. People can put in the region that they live in, and it will highlight it. We found this works really well. People love personalization, and this kind of interactive chart got double the amount of views as the guide itself, so that's quite interesting. And also we're hoping, because we've had quite a lot of positive response from this approach, we're hoping as a bank to launch a kind of social media chart blog called We Heart Charts, where we can kind of put out very simple stories in a chart about things that we're interested in. So I'll just show you a couple of these, which is the banks trying to advocate this more studying of economics at secondary school, or the kind of disciplines, disciplines around economics, like using evidence to make decision making. And we can just put out a chart just to highlight this, saying, look, 1 in 1,000 exams sat are in economics. This seems like not many people are studying the subject. And here's a Bitcoin one. So again, a story in a chart. We're trying to explain that Bitcoin is just so volatile, and get that across to people. Price doesn't always go up and up and up. And so here we're saying, look how volatile it is compared to oil, which is a typically volatile commodity, and then the pound after the EU referendum, which it looks tiny in comparison to the volatility of this cryptocurrency. So this is kind of the road we're going to start going down. It's kind of simple key messages, evidence-based, and then directing people back to other kind of more detailed communications on our website. Yeah, so that's me. Sorry for the rush through. No worries.
Would have liked to do in a way was to have had a discussion before you came up with this on the and maybe we can catch up for right now. Yeah, yeah, okay, yeah. But I think we want to go into, isn't it, into the, actually, we're not avoiding that, into the cryptocurrencies, crypto assets, ICOs, digital fiat. And if those who were so kind to join us can stay a little bit longer, we could make it a bit longer than 12:30, but not too long. So I think, as I said, the dynamics is not of interaction, and the logic of the interaction is not always controllable, particularly if you want to bring in people virtually and so on. So I suppose is Douglas or Chris or...
shall I go first?
I suppose, because...
I apologise about having to leave at 12:30. I've got to do an interview with American newspapers. They fixed the time, unfortunately, and I agreed to it, which I probably shouldn't have. I'm Douglas McWilliam. I'm sorry that I'm a boring economist and will therefore bore you all to tears. My colleague Cristian Niculescu-Marcu is the brains of the outfit, and anything intelligent that comes out of the two of us will come from him, not me. I used to be the chief economist for IBM UK, the chief economic advisor at the CBI, and then I decided I better get a real job, so I set up which is the third largest UK independent economics consultancy. And we specialise in forecasting, and because of my background, we've done a lot of work in the tech sphere. I also wrote the book, The Flat White Economy, which described London's digital sector, and it's still selling 50 a week, even though it's 3 years old, which seems to me quite remarkable, because I think now it's a work of history, not a statement of fact. But some people like to buy it. Maybe they like reading about history. I don't know why. I certainly won't recommend anyone buys it now. And my next book coming out on the 1st of November is The Challenge to Mr. Piketty, it's called The Inequality Paradox, and talking about the impact of globalization and technology on inequality. We've done quite a lot of work on how the digital banking will affect the economy, and we did a study nearly 15 years ago for British Telecom, where we estimated that the total cost of banking could reduce by 95% through the application of various digital technologies. Now, it has not come down by anything like 95%. So we got that forecast wrong. But I think one of the things one might want to consider in this context is why we failed to harvest a lot of the big fruits that we could have got from digitization, and whether there are things that we need to do better, because I believe that technically we can do a lot better. We recently released the report with ZYN and Long Finance on the economic impact of smart ledgers, particularly in the context of trade. And Cristian is the guy who wrote this report. And so I think the sensible thing for me to do is to hand this microphone over to Cristian, who will tell you about it and also give you his thoughts on digital currencies, which I'm afraid are slightly different from mine. But it's that tension that gives us the ability to learn.
Waiting for him. What are the signals for the future from your point of view? Don't look at him. Look at us here.
Make sure he answered the difficult question.
Exactly.
And that's a difficult question, so
It
he ought
is.
to be answering it. Well, I mean, as I see it, the future is digital.
Yeah.
Remember, I was chief economist of IBM 25 years ago.
Yeah.
25 years ago, they said the internet would happen immediately and it would be a major commercial platform in the mid-1990s. I would say that it became a major commercial platform round about 2010 or so. So 15 years later than they expected. I think we've only just scratched the surface of how we yield the benefits of digital technology. I think now, with so many more countries trying to gain these benefits and trying to gain them in different ways, I think the next 25 years will astonish everyone who is here. I won't be around to be astonished in 25 years' time, I suspect.
You never know, technology develops too.
Possibly that, possibly that. But I think we will be just amazed by how fast finance does develop. And I think we're now in a phase where a lot of the technical building blocks exist. We're now into an implementation phase. And I think that's the phase where things happen most quickly. So I'm optimistic about the next 25 years. I think they could be very surprising to everyone, and including me.
Actually, Douglas, I'm sorry, I'll bring you in, Cristian. The other day, I was trying to see how can I get the governors, while they are around here in London, around the Smart Partnership, to an exhibition or something which could shock them as they did before when we've been doing that. And I came across the VNA, the future starts here. I'm advertising for them, but if you have been there, we are trying to go tomorrow, but there, one of the sections besides what he's going to talk about is about longer life. So probably you'll be here in 20 years anyway. But I recommend...
Lifestyle adjusted, I'm already 125 years old.
Okay. Please.
Okay. Well, thanks, Doug. I think it just makes sense to provide some overall context in terms of how we got into this and why it is that we became interested in blockchain and sort of mutual distributed ledger technology and the sort of economics associated with it. So towards the end of last year, we got in touch with Michael Manelli, who heads up ZEN. And he was keen to do a project with us on the economic implications of blockchain, but he was more sort of interested in mutual distributed ledger technology. And so during the first meeting we had with him, you know, obviously when I heard blockchain and sort of being a sort of amateur financial market pundit, aside from my full-time job, I came at him with all this sort of cryptocurrency stuff, and he turned around and he said, it's got nothing to do with any of that. What I want you to understand is that blockchain technology or mutual distributed ledger technology at its heart is basically about data, and what we're talking about is a sort of decentralized database, right? So whereas over the last few decades we've become used to sort of having data being centralized in places and databases, and you know, we heard about trade repositories, and big data has actually taken place among the sort of centralization of it, which makes it quite vulnerable. At its heart, the sort of underlying technology behind Bitcoin and sort of Ethereum and all the other sort of cryptocurrencies, which I'll get onto in a minute, it's about data, and it's about recording transactions in a distributed way that makes it sort of more secure and less vulnerable. Now this is important for sort of outside of cryptocurrencies. This is important as far as sort of record keeping is concerned, because it means that the way that we manage data, the way that we work with each other, the way that we store it can be a lot more collaborative, and it can be quite different to the sort of centralization and synchronization process that we've seen up until now.
You can eliminate lawyers.
And counterpart and centralized counterparties. So the people in the middle who sort of check and verify things can be sort of it's part of the sort of wider economic phenomenon that people sort of call disintermediation. And whether you're talking about financial disintermediation or trade disintermediation, it's about hooking up sellers and buyers without the need for intermediaries or sort of counterparties that would otherwise smooth the exchange. So the project we did with Michael was about trade. And Michael Manelli. It was about trade and looking at trade, because actually, although there's an enormous amount of world trade taking place, and lots of stats are thrown about, and people will sort of quote figures of sort of 17 to $20 trillion of global trade every year. Actually, what's really interesting is that this trade is subject to a lot of stress, because you deal with people in other countries, you don't know those other countries, you don't know the systems, sometimes countries have different levels of institutional credibility, not to mention language barriers. Some countries have common law, others have the sort of civil code. So there are lots of barriers, lots of frictions, and that's even before sort of talking about the tariffs and all the rest of it. So trade around the world actually takes place in a highly constrained manner. And there are regional blocks. I mean, you've got the EU, which of course facilitates much smoother trade because of the sharing of institutions and standards and so on and so forth. But when you're talking about world trade, especially under WTO standards, you get these frictions. And so the question comes back to how we can sort of use mutual distributed ledger technology to bridge these information asymmetries. And you go back to sort of classical, well, not sort of classic, but mainstream economics. There's a sort of idea that if you eliminate information asymmetries, if you provide more information, you have fewer deadweight losses, you have more exchanges that can take place, you have more efficiency and a more efficient trading system. And so our work within that basically linked the possible cost clawbacks that MDL solutions can help to bring about. And that's basically because you have a record of who the person you're dealing with is, their prior business. You have a lot of transparency in terms of what other people are saying about them. You have the sort of time stamping and validation that can verify that the people that are providing feedback on this other person you're trading with are sort of talking about real exchanges and real trade that has previously taken place. And so there's this sort of element where, even though on a global basis we don't have anything akin to the sort of we don't have a global single market, we have a sort of WTO that's sort of struggling along and has tried to sort of bridge some of these barriers with varying degrees of success. What it really comes down to is the fact that you can use technology to sort of bridge some of the institutional deficits that exist within the global trading system. And there's so much global trade taking place, so much of it is constrained, there's so much more that can take place, that even on a sort of constrained and very, very conservative basis, because we didn't want to go out on a limb given that this is still a sort of experimental technology and lots of conceptual sort of assumptions being made, but we sort of reckon that there could be a $35 to $70 billion boost to global trade, even under very conservative assumptions associated with a mutual distributed ledger platform. The more aggressive assumptions you could make, I mean, if you think about the fact that you could have, and sort of introducing the cryptocurrency angle, you could have tokens and other things disrupting sort of trade financing and the existing trade finance industry, and sort of lower the cost of financing that trade. The effects can be really multiplicative. And so that's where things stand. Now, I think this is very important because obviously as the UK leaves the EU, the institutional pillars of our existing trade relationships are going to change, and so this allows for some limited clawback. But it's also important as far as the Commonwealth is concerned because there's a certain degree of institutional affinity, common language spoken in most Commonwealth countries, and a sort of cross-familiarity that means that the natural sort of trade affinity that Commonwealth countries can have with one another can be further enhanced with something like MDL. And then if you tie that in to the sort of African free trade area and a lot of these developments that are coming through, which are exceptionally exciting, you sort of have the situation where, because I alluded to earlier the fact that a lot of people sort of look at Africa and see this sort of development gap, and they just say, well, there's a big development gap and Africa's got all these disadvantages. But actually, the advantages are that you get to sort of jump straight to the conclusion, which has basically been in the making over the last few hundred years in the Western world. You can sort of jump over all of those details to the sort of smart way of doing commerce and business. And so if you're thinking about something like an African common market, if you're thinking about turning the African Union into a sort of single market, like we have in the European Union, you've got opportunities to leverage a lot of these technologies, because you have different ways of sharing information, you have different ways of regulating and overseeing trade, you have different ways of basically seeing the development of that single market. And so, I mean, that's just something that I think is really important and really topical, and I wanted to highlight that, because I feel that, you know, unfortunately, when people talk about blockchain, the next thing they mention is sort of cryptocurrencies. And I'm very much against this. I mean, from my point of view, the biggest problem with cryptocurrencies is that we call them cryptocurrencies. Okay, they're not currencies. Please stop. Let's stop calling them currencies. They're not currencies. I mean, you sort of have the three sort of traditional functions of money: unit of account, medium of exchange, store of value. Right. The problem with cryptocurrencies is that they're not a reliable store of value. Okay, so you look at what happened with Bitcoin last year. It rocketed up in value. So, you know, a lot of sort of economists in the West talk about sort of hyperinflationary trends in certain developing countries, and the fact that the money is worthless. Well, actually, we had the inverse of that. We had hyperdeflation. Our coffee shop down the street accepts Bitcoin payments, and I'd be happy to do it. It's just that I wouldn't know what the price of coffee would be from one day to the next if I chose to pay in Bitcoin. So it doesn't mean that there's no underlying value to these types of things, but actually they're not currencies, right? They're assets. You could sort of call them crypto assets. You could sort of call them digital commodities. Of course, they share the sort of properties of scarcity that you see in commodity markets. I was glad that we were able to look at the sort of volatility of Bitcoin and compare it to commodity. I mean, they're actually more volatile than commodities, but the closest thing to them in terms of the pricing trends and the volatility you'll sort of find in commodity markets, right? And so it doesn't mean that they're not useful, because you know, people use commodities for all sorts of things aside from their sort of industrial uses. They're used by portfolio managers to sort of diversify their portfolios and get sort of low correlations with their existing assets. And you know, maybe there is a space for it. Maybe they'll disrupt the commodity sector. Maybe they'll disrupt gold in the way that investors see gold as a store of value. And gold's actually quite similar, because you know, if you think about Bitcoin, it's another type of thing where people kind of see it as being valuable just because it's valuable, and it's got this sort of intrinsic mystical valuableness which has been seen in gold over the last few thousand years. So maybe actually what we're talking about is a different type of disruption, but again, they're not currencies. I think as far as cryptocurrencies are concerned, in the way that they're used, that there is another interesting angle to them, and that the way that financial markets operate at the moment, you know, we've got the sort of over-the-counter markets, sort of like issuing bonds, and sort of they're slightly sort of decentralized, and then you have the centralized exchanges, which is where stocks and shares are traded. Both of these platforms tend to work reasonably well amongst sort of established players. But when new entrants are coming onto the market, they sometimes pose barriers to entry. So, you know, SMEs, small companies trying to issue capital might not want to go to the stock market, because listing and sort of doing a share issue entails a lot of costs, a lot of sort of burdensome bureaucracy and oversight and processes that they might not be willing to go through. Similarly, if you look at over-the-counter markets, I mean, you know, for example, there are lots of African countries that would love to sort of do more in terms of issuing foreign bonds, but actually the problem is that a lot of these sort of Euro bond markets are controlled by fairly cozy sort of networks of banks and intermediaries, and a lot of you know, they've been accused of sort of cornering the market and pocketing fat spreads, thus you know, lifting the yields obtained on the bonds and sort of the costs of financing. So what you could think about cryptocurrencies as being quite disruptive as far as funding is concerned, and so getting sort of to the ICO idea. Now, ICOs aren't interesting from the point of view of issuing a currency. ICOs are interesting from the point of view of finding out or exploring new ways of issuing securities that help governments or companies fund themselves. And if you think about the sort of blockchain exchanges, right, and the way that they operate, that's really, really interesting. Now, obviously, a lot of it sort of depends on how they come to be regulated. That, you know, securities are regulated in quite a robust way by most sort of jurisdictions, and there are other sort of systemic issues that the Bank of England and others are going to be worried about. But when thinking about cryptocurrencies, I think the funding angle and the new avenues for sort of treasuries to fund themselves and also for companies to fund themselves could be really interesting, because actually credit markets pose a very sort of considerable headwind to growth in the developing world, because in the developing world interest rates tend to be quite high. There are fundamental economic reasons for this. There are also other problems associated with Western or foreign investors not knowing enough about these countries, hence they price in these huge premiums, and premiums make investment prohibitive. So there's that angle as well. So let me just sort of pause for a second, because I've gone through quite a lot of stuff, and ask if there are any questions at this stage before I get to the second part of what I wanted to talk about.
What do you want to talk next?
Digital fiat currencies.
Okay.
Yeah.
You
Yeah.
want to come in yourself, Oliver?
Yeah, I also agree you can't call them currencies at the moment, because, as you've highlighted, they're not an effective means of payment, store of value, medium of account, all the traditional aspects that money had. Although I would say, as our colleague from Zimbabwe has noted, that kind of, you know, the genie's out the box, and there are some very smart people working on this. There are stable coins. There are things where you can peg these to existing fiat currencies. There are things like Lightning Network and others add on to which can basically speed up the payment. So I would agree with you at the moment. They're not currencies, but I would say that we can't just, you know, sort of shut our eyes and say that's that. Wait to the next financial crisis. We saw in 2008, this is kind of a side effect of it. Wait for the next crisis and a lack of confidence in central banks and the economies, and you might see people pushing even harder to use them as currencies outside of existing financial systems. So that raises severe monetary policy questions. I think on the asset side, I agree with you, though. ICOs are a great method of capital formation. You know, the VC model in a lot of places is broken. This is a great way of starting early stage companies if it is properly regulated. I think last year there, within 1,000 plus ICOs, half of them were frauds. You know, obviously if this becomes initial coin offerings or initial token offerings, and this is essentially where a company with a DLT basis, a blockchain basis, issues their own token. And again, I wouldn't call it a currency. I would prefer on the ITO side. And those tokens can be used for different reasons. And this is where you look at the Swiss and FINMA and how they've started to regulate it in different categories. So you could have one that is a utility and it's used within the company. You could have one that acts more as a security or an equity investment in the company. And I think this type of capital formation would be great for countries, because if you regulate the market, you're opening it up so that SMEs and others can grow for all the reasons that my colleague here has pointed out. I am from OMFIF, the Official Monetary and Financial Institutions Forum, which is a really long thing to say, so we say OMFIF instead.
Just to sort of reply to that, I mean, I strongly agree with the notion that you need to sort of distinguish between the floating sort of cryptocurrencies that show these volatility trends and the fixed ones. I think you could sort of think of them as money from that point of view because of the stable value. But of course, that stable value is sort of, I mean, it's nominally true, but then I think there's also a certain risk premium that would be attached to that. So maybe the stable value and the sort of difference between the cryptocurrencies that kind of float and are volatile versus the ones that are fixed. Maybe the best way of thinking about that is sort of like conceptually thinking about the difference between debt and equity. Because, yeah, obviously debt is sort of guaranteed amounts and you don't participate in the upside and downside, and the other one is sort of more like an equity type instrument. And we've come across companies that basically issue both types of coins, the fixed ones and the floating ones, and sort of from a conceptual point of view, it's more akin to sort of debt versus equity. And of course, you can use debt. You can use debt securities to, I mean, you know, a lot of people think that sort of paper money is a form of sort of debt security anyway. Now, in terms of using the actual cryptocurrency. I mean, you can use them as currencies if you want. You know, people before our fiat system, people used to use gold and other, you know, salt in sort of North Africa. So, you know, people have been using commodities as currencies for hundreds of years, thousands of years potentially. So it is doable. But what I'm saying is that if you are to use them as currencies, you are, I mean, that's not really very efficient. And one of the revolutions we've seen in the global economy, from my view, over the last few decades, has actually been the sort of fine-tuning of monetary policy to get the fiat system right and to sort of smooth over a lot of the other frictions. Yeah.
Just to go a little back and forth here, I think that, yeah, so from a central bank point of view, for monetary policy, cryptocurrencies right now aren't a huge concern because this isn't used as widely, but it is something to keep an eye out. Financial stability, I think colleagues from the Bank of England pointed out earlier, at the moment, really, it's a risk to consumers. So there are people out there losing money, and I think the best thing that central banks and regulators can do is advise and, you know, educate consumers that there are risks out there. I think that where the regulation comes in, it should probably come in from the securities regulators. It would fall more within their remit. Now, in terms of systemic risk, that I think is also going to come. So there are some companies working on third-party custody solutions, which is what has been hindering hedge funds and institutional money coming into the market and playing with it. So I do think that in 5-10 years, there is going to be more of an institutional investment into the market. And that could pose systemic risk to parts of the financial system. So that is something where I think central banks should look at from a financial stability point of view at the moment.
Well, not to mention the futures, the Bitcoin futures that were launched in the US last year, which have already sort of attracted investor flows. And, you know, so we could end up sort of, I think terminology is on a sticky wicket, right? Yeah.
Your newspaper cannot.
Yeah, I can stay behind and finish off. Yeah.
Actually, if you're missing the Wall Street Journal, Financial Times is here. Alan Smith.
Yeah.
Thank you very much. But he's here as Alan, not as Financial Times.
Okay.
Yeah. But thank you very much, Douglas. Really very good. No.
This is the area where the West is learning a lot from Africa. It's a country that's in the lead worldwide. I'm very grateful to have the opportunity to learn from you. So thank you very much indeed.
Thank you for joining us. Yeah, thank you. Okay, a few words on fiat.
Now on the digital fiat
and then
currencies.
Pete has a question,
sorry,
but you can can you ask later or do you want?
Yeah, I can ask later.
Later, yeah. Let
Okay.
Cristian.
Okay.
Thank you, Mihaela, and thank you very much, Your Excellencies and governors.
Yeah. Just should we wait for Mihaela or okay? No. So on the digital fiat currencies, I don't think that sort of blockchain technology is completely irrelevant as far as monetary policy is concerned and as far as sort of currencies are concerned. As I said, I want to move this away from sort of cryptocurrencies, but I want to talk about our existing financial system and the way that you know, the fiat currency system has developed throughout the course of the 20th century in the form of the sort of narrow money base that exists, and then the broader definitions of money, sort of going to M2, M3 and beyond, and how we sort of have this sort of blurry distinction between money and credit. Now, of course, we still have physical money in the economy, and we still have physical banknotes floating around, and you know, a lot of these transactions take place. We heard some stats earlier in terms of, what is it, 9% of the UK population that still uses physical money. And of course, that's sort of very important to consider because there are lots of people who are sort of not technologically savvy or not too keen on banks. Of course, there's also the sort of underground or sort of black market where you know, a lot of exchanges take place that shouldn't be taking place, and a lot of this tends to be cash-based. So actually, if we got rid of physical money, we would make it more difficult for illegal activities to take place, which wouldn't be a bad thing, right? But we do have to bear in mind that there are lots of vulnerable consumers out there, and if we were to get rid of physical currency, you know, they would suffer, or they'd need to adapt, or they'd need to be helped to adapt. But I think the overall idea behind it is that if we could sort of take the narrow money that exists in the economy, sort of like monetary base or close definitions thereof, and replace that with a sort of blockchain standard, right? That can, I mean, it wouldn't be like Bitcoin or anything like that, but it would be a central bank run, tightly regulated blockchain standard. And then monetary policy basically is focused on either sort of expanding or contracting that that amount of whatever you want to call them, sort of tokens or sort of narrow currency units. That might be quite interesting, because then essentially that allows a sort of continuity to exist in terms of how we run monetary policy today, in terms of affecting the money supply. Right, you could even run it the same way in terms of changing the interest rates and then seeing the results on money supply. But it would make the existing system, I mean, paradoxically enough, whilst a lot of people are talking about cryptocurrencies kind of disrupting the existing monetary system or whatever, I actually think that the underlying blockchain technology might make the existing monetary system work a lot better. Because if you get rid of physical money and you have a sort of blockchain narrow money on which all the sort of credit multipliers are built on, that basically allows you to do a number of things. Firstly, you get rid of monetary leakages, so no more sort of money under the mattress or under the pillow or in people's wallets, which, you know, you could say that for that period of time, it sort of left the money supply until there's a sort of another transaction taking place. Because people are always spending sort of digital currency, they kind of are always going to be tapping in and out or sort of, you know, using their debit cards. And so all the money that they have in savings can essentially be used by the banks for lending and investment. So it can potentially boost capital investment and sort of eliminate a lot of the leakages that exist there. And then on top of that, you're also sort of helping to clamp down on illegal activities. Now, if you did that, I'm sure a lot of illegal activities would sort of migrate more to the cryptocurrencies, which is what they're doing anyway at the moment. But given the sort of undesirable properties of cryptocurrencies as stores of value, life would be more difficult for them. The other issue that I wanted to mention is more a sort of technical issue with regard to monetary policy. You know, since the financial crisis, we've heard a lot about the sort of zero bound problem. You know, and you can't sort of, interest rates can't be too low or negative, because if they are and people start being charged negative interest rates, at some point they'll take their money out of the bank. It's interesting that the one central bank that did sort of robustly experiment with this, the European Central Bank, wasn't faced with this problem, but then of course the rates that they were charging were negative, but they were just sort of slightly negative, and so a lot of people thought that although the rates were negative, you taking money out of the bank and putting it in a vault at home that would be more costly than the negative interest rate that they were charging the banks, and then of course they never really charged those rates to the consumers. So there's that aspect. But if you got rid of the zero bound problem, you wouldn't have to sort of come up with things like QE, which in themselves sort of cause asset market distortions, and you know, the implications of quantitative easing as a way of dealing with the zero bound problem. That whole discussion could be sort of avoided. I mean, conceptually, there's nothing wrong with a negative interest rate, as long as that negative interest rate is kind of reflecting the fundamental structure of interest rates in the economy. So if you have sort of expected deflation and negative growth and you're in a recession and things are bad, just like we have market interest rates that sort of encompass expectations and so on and so forth, there's no reason why interest rates can't be negative. The reason why they can't be negative at the moment is more sort of a technical issue to do with financial stability and the withdrawals that can happen with physical currencies taking place. So for me, that's actually really important, because I think that although quantitative easing has helped and has been enormously useful in helping us deal with the financial crisis and all the associated impacts, it has caused a lot of distortions. And if we can find a way of doing unconventional easing without a lot of those distortions and distribution problems, that might be something to look at.
So just, it's getting late. We're all a bit sleepy. We need some food. It's very stuffy in here. So very quickly, so to explain, I'm going to take it back because it's been a long morning. In basic terms, what Cristian is talking about is a retail central bank digital currency. So what that is that's allowing the wider public access to central bank money, whether it's through a token or whether it's through what most central banks are looking at, which is widening accounts to the general public. which means that you have monetary policy control over those accounts. So that gets rid of the problem about zero bound, because you could literally affect the interest rate on or the amount of money in those accounts. Now, widening access to central bank money has lots of implications. For one, you'd be taking away money from the commercial bank sector, and that could pose a risk, let's say in times of stress, where there would be a run from the commercial banking sector to the central banks. I'm still trying to figure out how you sell central banking money to Joe Public. That's another question for you all to think about. The other side as well is that there's another kind of central bank digital currency, and this is the one that people are working on right now, and they've probably come to you and talked to your banks about how they can implement it, and that is a wholesale central bank digital currency. What that's talking about is using DLT and blockchain to change the global payment system, where essentially you can use a digital token to speed up the efficiencies and reduce the counterparty credit risk between financial institutions, so they can trade using that. And there's lots of different models. Different tech companies, different private banks, even central banks have ideas on this. I'm happy to chat about it a bit more, but it's important to make that distinction between the two.
It's for the first time that we have heavy economists and here, but for the governors, together with integrating these digital disruptions. We have a digital team here, digital emerging team. So Governor and I, we thought that to end up and to go to lunch and then we come back, we'll get a quick feedback from each of them to see what do they think, but very quick as signals, for the governors, because quick is Pete or quick is Oliver.
Negative interest rates. I think the FT's got a good article on why the Swedish central bank defends negative interest rates. So please look at that, because it has happened and it is happening. Yeah. Well, Sweden's economy is not that great, to be honest. But the other thing they're doing is something I call what is called war on cash. So be careful of the war on cash, because you will drive people towards cryptocurrencies. That's all I can say now.
I suppose there's one number of things. If we go back to the question earlier about what's the difference this time to the last 7 times, given that I wasn't here the last 7 times, I'm going to try and answer that. And I suspect that now we're talking not about the technology and trying to understand that, but actually trying to understand and work out how it's used in real life for real people, both the haves and the have-nots, given the inclusion piece here. I also take issue, or would like to add, with the view of the blockchain as a data source. Yes, it is a data source. Question about who owns that data and how that data is utilized. But in reality, I think for a lot of people, it is about trust. It is about you trusting the system as much as you trusted the bus driver to send money to your mother. As much as I scared the living daylights out of a financial controller once, asking for 50,000 quid in cash, handing it over to a taxi driver under London Bridge, and 3 days later it popping out in Puntland, the Hawala system. There are these systems that work very well in trust. They rely on trust. We have, in many human interaction systems, lost that trust, and the blockchain is one of the ways in which we can put that back, combined, I would say, with identity, but I work in identity, so I see everything through an identity lens.
Mike, you didn't mention that you were from IBM also before, but please.
Thank you, Mihaela. What a nice presentation. My take on, just to build on what my friend have said here, is much of explanations was looking like war on currencies, but it's true. These are things that are built on trust, and there is a eroding of trust to fiat currency. That's a fact. And we have to understand that now we are in level number 1, where we are looking at different of services that people are using to advocate cryptocurrencies and things like that. But there are some people, especially the one that where the banking service have not reached them, where they found that there is advantages on how to use the cryptocurrencies. Because we know there's a block of 3 layers, where in the initial block, we are talking about the services that one or people are using to advocate about these new technologies. But when the trust is built, they'll start to use them as banking services. And when the trust is built on that, it becomes a cash, whether you like it or not. So this is the caution point that I wanted to give to advance this discussion.
Mike is also part about
yes. So the two people have just spoken about the element of trust, but I think the key elements from my perspective are broader than that, and these are, it's actually the balance between trust, risk and value, and how the central banks or the governors, or there is governance of those three dimensions, because from a supplier-consumer perspective, all these things are in balance today, whichever the environment is, but digital technology, blockchain, distributed ledger changes all three of those dynamics, and it's how those dynamics are managed in the future, to me, is key.
I think one other thing, we brought in, Emily just came in to add to the trust, because there is this standards going around and trying to build trust with the standards on blockchain technology, just very, very quick, and then we'll go to lunch.
Hi, well, sorry about
Emily
being late.
from
I had
BSI.
an earlier meeting this morning, so I had to arrange that before I was able to come here. In terms of where we are at standards, I'll give you a bit further
Standards
of an
and
update.
blockchain.
Yes, absolutely. We have a few more developments since the last time I was here to update you guys on. It's been a fairly new development that we have put together a standards community to really look at how to incorporate international standardization to better support industry and the work that's being carried out by startups, various, different banking services, different aspects of blockchain being incorporated into existing structures. IBM's got some excellent case studies around food supply chain, etc., that are being implemented at present. So what we're looking to do is to provide a bit of extra support to either back up legislative efforts or to provide a common understanding of how industry consensus can be built around what good practice and best practice is.
There is so much, but we're pushing the limits for lunch. But we were watched live, what we're discussing here. We received some comments. So I suppose we'll break for lunch. They are going to break for lunch or go to bed, wherever they are, our smart partners. But you're invited in the garden. There is a garden, and there is a garden networking room, and there is some refreshment there, and there is a screen also, so you wouldn't escape for about 5 minutes. There is an artificial intelligence experiment, but it's actually more than experiment. It's about an audit procedure that our smart partner from Canada, from Ottawa, Robin Grosset, just made available to the governors, and to include in their future FinTech hubs or something like this. So please, we'll come back at about 1:45, but please join us downstairs. Thank you very much.